Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/rive to receive the top 10 stocks to buy right now. AT&T reported earnings this week, and there wasn't a lot that investors liked. But the question that I want to ask is whether this 6.1% dividend yield, which is extremely high even in today's market, is going to be sustainable. Because I think at the end of the day, if it's not, that should really tell us a lot about the future of AT&T and where this stock is going. So that's what I'm going to dig into, is the earnings trend and how that flows to the bottom line and ultimately the dividend. My name is Travis William. Thank you for watching Rive Investing. Please subscribe here on YouTube for all my content. Now let's dig into the earnings report here and some of the numbers that we saw. First off is the way that AT&T presents itself, because going through this, I think it's really interesting. They always post these really impressive numbers, but then you start digging and they look a little bit worse than they do initially. So postpaid phone subscribers was up about 2.5 million units from a year ago. Average revenue per user was up by $1. Mobile services revenue is up. Mobility EBITDA is up. AT&T fiber is up. Everything looks like it's doing really well. But then you get to the financial results and things get a little bit more questionable. Revenue not up nearly as much. Now that's partly because they're not selling as much hardware. That's actually okay because hardware is typically a low or negative margin for a lot of these telecom companies. They're kind of doing a razor and razor blade model where they want to sell people new smartphones to get them to sign contracts, but they make money on the contract side. So I don't want to read into that too much, but we are seeing earnings fall and cash from operations fall. So that's really where I start to have a red flag when I start looking at AT&T's earnings results. And you can see here, free cash flow of $1 billion reflects seasonality, capital investment cadence, and timing of working capital. It includes $1.3 billion from DirecTV. So there's a lot that management is telling us here, but at the end of the day, not only is free cash flow down from $2.8 billion a year ago to $1 billion, but operating cash flow is down almost $1 billion to $6.7 billion. I want to dig into exactly what's going on here. And I know that this chart is a little bit hard to read, so hopefully you can see the important numbers. But I just want to go through the trends here. This is data from the first quarter of 2021 all the way through the first quarter of 2023. So gives a really good idea of where the company is trending, where revenue is trending, and then I'll get to EBITDA in the next section. But let's start with revenue. Communications revenue is up slightly, $28.2 billion in Q1 2021, $29.2 billion in the most recent quarter. Most of that is driven by an increase in mobility. Actually, business wireline is declining. Maybe not all that surprising, but it is declining pretty rapidly at this point. And consumer wireline is actually doing relatively well, up slightly, up by about $200 million in the last 2 years. So definitely not a drag on the business, but there's kind of some positive and negatives here that are offsetting each other and resulting in relatively modest growth overall. Mexico is actually doing really well, $631 million to $883 million in revenue. There's some oddities here related to legacy businesses, so you can kind of ignore these first 3 quarters from a corporate and other revenue standpoint, but that's effectively flat over the last few quarters. Now, when we get to EBITDA, this is where things get really interesting. Mobility, again, this is the traditional AT&T mobile services, is actually doing pretty well. $7.9 billion to $8.4 billion, at least moving in the right direction. Business wireline, moving in absolutely the opposite direction, effectively losing everything that the mobility has gained from a growth perspective, down from 2.1 billion to 1.7 billion. And then the consumer wireline business, remember that revenue was going up, but actually EBITDA is about flat. Mexico, similar trend, much smaller business, but the EBITDA is getting a little bit better over time in a great quarter in the most recent quarter. And costs are going up as well. So adjusted EBITDA up slightly over the last year, but maybe not over the last year or so, but maybe not nearly as much as investors would think. And here's where we get to the big number right here. The dividend is costing AT&T about $2 billion per quarter. That means that they need to make $2 billion in free cash flow per quarter to pay the dividend. If they don't, they're going to have to take on debt or pay out of cash on the balance sheet to be able to continue that dividend. That's not happening right now. And so that's what I think is really alarming for AT&T. If these trends continue, I don't think AT&T's dividend is going to be safe long term. We could see the company adjust by doing things like raising prices or cutting costs. But neither of those is really great for the business long term because it shows the fundamental weakness that they're in right now. I would love to see them do something like get into fixed wireless the way that Verizon has, but you can see they have a big wireline business. So they would be kind of undercutting themselves there. I think this is a really challenging point for AT&T. I really like Verizon's strategic position better. I think their financials are a little bit better. We'll see what they look like when they report earnings here in the next week or so. But I think we really need to start questioning AT&T's dividend given the debt that they have on the balance sheet and the likely increase in interest rates on that debt over time. But I'd love to hear your thoughts in the comments section below. Don't forget to subscribe to Rive Investing. Thanks for watching, everybody. I'll see you here next time.